Hey, good morning, Chris. How are you doing?
Good morning, Mr. Jones. I'm good. How are you?
Good. This is Brian Jones. I'm here with professional trader and world's most interesting man, Chris Hood.
World's best designed haircut now. I've decided I wanted to stop looking like a hay bale and
Mhm.
start looking a little bit more human. So I had to do something with the hair
Yeah,
today.
you're looking sharp, man. You're looking sharp.
It
I
looked
see
a
the
little different.
jujitsu gi in the or whatever the gi in the background is like still locked down up there. No jujitsu yet.
Yeah, no, still locked down. That's the karate gi. The jiu-jitsu gi's over here, but it's man,
So are you
I'm
still
already
doing
used to punching people in the face.
are you still doing karate?
Yeah, still do. I practice at home, but it's not the same. I haven't hit anyone in months. I need to
It's
hit people.
terrible, man. Just go to the grocery store and find someone who's rude.
The problem is when I go to the grocery store, I'm generally the youngest in the line, and I'm not young at all. So I've got all these old people in front of me, and I'm looking at this old granny with a little trolley with a push cart, and I'm like, I could take her. I could take her. I think I'd sink my hooks in and give her a rear naked choke or something.
Yeah,
You know,
be easy to do. Easy to do. So, what do you think? The market seems a little fragile, or it has been. I've been a little hesitant
the
about.
hesitance is a good thing at this point. I can't tell where it's going to be. I mean, no one can predict. I mean, this nonsense that was going on last week just blew my mind completely because when you've got people who you've never spoken to or you haven't spoken to in a long time texting you saying, hey, have you bought GME or have you got AMC and stuff like that, I'm like, this is the time to get out because when the least experienced person calls you to tell you, who trades every day about AMC and GME, then
Yeah,
there's something wrong. So you know what? I like the situation of Wall Street getting a lesson. Like, don't get me wrong. There's something very inspiring around the guy who lives in his car with $600 now suddenly having a couple $100,000. I love those stories. All right.
yeah,
Kudos to him. He wins. Great. The problem is with this, someone's going to be left holding the bag. And from my experience, it's not Wall Street.
oh
You know,
yeah, yeah,
these guys are smart enough to know when to get out. And I can tell you, most of these hedge funds that lost billions last week, they're already gone. They've gone. They've paid their lumps. They've taken it on the chin. They've moved on. So
yeah.
the only
People were asking me about it too, just because they knew I did some trading, and I'm like, it's. I was actually watching an interesting interview with Jordan Belfort, the guy that did
oh yeah, I
Wall
saw that one
Street.
too.
Yeah,
Yeah,
and he was saying he called it like the average person effect. He's like when your grandmother is and that doesn't trade is asking you like about GME, it's like the ship has
it's
already
gone.
sailed.
It's
It's
time.
time to get out.
It's
If you're
past.
still in, get out. It's because
Yeah,
it's bad.
very good advice. The thing is, short trading, I love it. All right, don't get me wrong. When we've traded to the short side, you get much faster results, but it requires a completely different mindset. You can't go into a short trade the same way you would go into a long trade because the speed at which things happen is a lot quicker, right? So remember, there's an analogy in trading or in stocks. We take the stairs going up and we take the elevator going down, right? So there's some funds that position themselves for the elevator drop, right? That's cool. I'm all cool. I'm cool with that. Short trading provides a very valuable liquidity mechanism into the market. So you can't fault them for doing what they did. All right. So morality and ethics aside, if you don't like short trading, then don't do it. But from a functionality of the market, they did exactly what they did. What I don't like is that these hedge funds and these institutional investors screw retail investors every single day. Every single day. Brokers, the market is geared against people like us. It's not there to make us wealthy. It's there to make them wealthy, right? So there's still this us and them. So when we have a situation where you can almost crowdsource the decline or the destruction of a hedge fund, I am all for it. I will sit on the sides. I will go shirtless in -20 with a sign. I will do it. All right. The problem is this: trading is not a game that you can learn out of a dummies book or in 5 minutes. So when the guy at the gym is telling you, hey, get into this, and people listen to it, all right, and then they go in without any forms of checks and balances. They have no plan. They're just going to take their parents' mortgage and they're going to dump it into AMC or whatever it is. Those are the guys that I have zero sympathy for. None. And if you lose, good, because it taught you a valuable lesson. You don't chase this, right? You know, we traded GME from December through to January. We made a couple 100% and we're out. We didn't get the big gains, but that wasn't our plan. Originally, that wasn't our plan. We trade for a much more conservative, consistent kind of return. And you saw the results from last week. Our average win rate, or our average winning percentage last week, was 105% of 25 winning trades. So to do 25 winning trades, all better than 100%, that's exceptional by anyone's standards, right? Why would we risk, and why should anyone risk taking $3,000 or $30,000 and putting it into a crap stock like, GME that shouldn't even be in existence, right? This company doesn't even make money. I don't get that. That's the thing that really gets me, is that you now have these people who've become very, very wealthy very quickly. And it's like the lottery effect, right? How many lottery winners do you hear about winning millions and suddenly within 2 years they're back on Skid Row? And
they don't have any sort of financial management skills. They go out and spend it all or immediately.
Yeah.
So I'm just kind of curious what you think the viability of some sort of underground Reddit, or I guess they got kicked off of a lot of platforms. But I mean, is this a reasonable thing? And I don't know. First, it's probably illegal.
Well, the thing is that's illegal would be collusion, right? So if you go in and say to someone, "Hey, let's go and gang up on this guy," and do that, that's no different from what the hedge funds do to us anyway.
Isn't that what the guy did essentially with this?
I don't think they. I mean, I went onto the chat thing and I read a couple of things and I was like, my Lord, I'm not going to be sticking around here. This stuff is to me, it's like stock filth. Like the language that they used is not nice for my virgin type ears.
Right.
And the thing is, it sucks people in, right? So I don't really want to be surrounded by the gamblers. These guys to me are like gambling addicts, right? They're going to go to the casino and throw all their money on black and hope it wins. There's nothing structured about it. So I tell people, stay out of chat groups, stay out of this. If you trade to a plan, you've got far more chances of success than relying on the guy who, inadvertently heard some guy at the urinal mention buying Airbnb or whatever it is, and then you went and did it, right? There's nothing structured there. The viability, I think the power dynamic will shift because this is a valuable lesson to the hedge funds. Don't get me wrong, hedge funds provide a valuable service to the market. The problem is this. So from a morality perspective, the people who lose in this are not the hedge fund owners. We're not taking down Cohen and Plotkin and all of these guys. They are still going to be billionaires. They're still going to be rich. They don't lose a cent in this. The people who pay are the nurses and doctors whose pension funds were allocated into those funds. Those are the guys. So when we're sitting around going, yay, we destroyed a hedge fund, you did nothing of the sort. Those guys are going to be back stronger than ever, and they're going to screw you over to get their money back because no one ever loses. They are not designed to lose. The person who's lost is the pension fund that invested into that hedge fund that's now lost 80% or whatever it is. And the nurse that spent the last 30 years contributing into that pension fund where the trustees don't lose anything either, right? So there's always someone who's going to hold the can. And this is why you don't want to play these games, because when things are stacked against you, your odds of winning are low. Why play in those pools? I don't want to play in those pools. So when I short stuff or when I go on to a potential short squeeze, you always have to understand the business behind it first. Does the business make money? No. Well, why are you doing it? Stay out of that game. GameStop became one of the most valuable companies in the planet, and it doesn't make any money. And now it brings me to the other point about Tesla. Tesla announces its earnings, and the only thing that kept it afloat was tax credits. I mean, could you imagine what happens if the government says, you know what, we're no longer going to give the tax credits for people to switch from petroleum cars or gas cars to electric? Those guys don't make any money. So why would you do this? It comes down to the fundamental of what we are trying to do in investing, which is invest in companies that are growing and make money. Don't invest in companies that are crap, don't have good management, don't make money. That's just taking a chance.
So when you look at investments, you definitely want to look at the fundamentals of the company as opposed to in trading where you're just mostly looking at price actions.
Yeah. So when I trade, I have to take a tenor view, right? I want to know how long am I going to be in this trade for, and where if I'm trading short term income, I'm trading around earnings or whatever it is. I don't really care about fundamentals. I don't, because I'm not going to be in the trade long enough for those fundamentals to make a difference. If I'm going to be buying something like Microsoft and I'm planning to hold it for 20 years, fundamentals play a much bigger value, a bigger part of the decision than the technicals on the chart. The technicals on the chart will tell me when to get in. The fundamentals tell me what to get into. So there's this fight, there's this line, and you've got a lot of, I trade a lot to generate capital in order to base my investment decisions, the long-term ones, on fundamentals. That's how I do it. So I trade on technicals and invest on fundamentals. Two different things. Don't confuse the two, because trading and investing, totally different things. I can trade a chart, doesn't matter what it is. I can trade, futures, currencies, commodities, whatever it is. I'll trade the chart, but I'll invest in things like Microsoft, Apple, Amazon, Google, those types of stocks. Companies that I know are not going to go to zero. That's where I like to put my money. Where there's a little bit of, hey, this company's a little overvalued. This company's not, trading at a high book value or trading at a high PE. I'm not too keen to do that, right? Because now I'm overpaying for things. So keep the two things separated. There's nothing stopping me from trading the same stock that I'm investing in, but I'll follow two different approaches, right? I trade Microsoft as well as invest in it, but I'll use different principles to guide each one of those transactions.
Yeah, that makes total sense. Excuse me, that makes total sense. One of the things that I wanted to ask you is, in a market situation, you talk a little bit about the market internals, about
Yes.
like looking at what the market's going to do based on some indicators and following. Can you just like give a brief rundown of how that works?
Yeah, sure. So one of the things that you've got to always look at is most people go into the market, they look at the index and they see the index up or down, and they make decisions based on up or down, where up is good and down is bad, right? That often isn't really the case. You have to understand whether the up is being caused by certain things that are positive. Sometimes you can have the index going up, but all the internals are negative, right? So the underlying thing, think of a patient in a hospital. You have all these vital signs. You have the breathing, you have the heart rate, you have the pulse, you have blood pressure, you have all of those things. You don't base your assessment on that patient by looking at one measure. Obviously, heart rate, doesn't have a heart rate. Yeah, he's great. Just leave him where he is. We'll give him the jelly later.
That's a fairly important one to start with.
It's a fairly important one. The heart rate could almost be like the index, right? So if the heart rate is moving and the index is moving, great, right? We have at least life at a cellular level, right? The issue that comes in is when you've got the guy stopping breathing, right? If you're not watching his breathing, but his heart's going, yeah, he's got a heartbeat, he's okay, but the breathing's starting to decline, or his blood pressure's starting to drop. All of those things tie together to tell you whether or not that heartbeat is healthy. That heartbeat might be going up in number, and you go, yeah, he's great. It's now at 195, and all of a sudden the guy, goes into complete cardiac arrest. Yeah, but his heart was beating. It was great, It's like going, oh, the market's up 50 points. Let's go all in, right? Well, do you realize what was driving the market up? What time of the day was it? Was it at 4 o'clock? Was it at 3:55? Was it at 12? Where was it before it went up the 50 points? All of those internals. I look at a couple of things. I look at the ticks. The ticks really are sort of like the heartbeat. It tells me whether the movement on the index is real or not. So if the ticks are going up, so we're seeing more people buying and the index is moving up, great. But if the index is moving up, but the ticks are dropping, this movement on the index is not real. You're going to get suckered into it because people are already selling. So ticks are almost like a slightly forward-looking indicator. It tells me whether people are buying or selling.
So you can track that. What's the symbol?
The thing is, in most of the trading platforms, it's called tick, T-I-C-K. You can have tick C in Think or Swim, which is the platform I use, which is the composite for both NASDAQ and New York. And you can split that out also. So tick is a really important indicator. The next one I look at is VIX, the volatility index, because the volatility index is slightly more forward-leaning, right? There's always an explosion in the volatility before there's a change in the index. So if I'm watching the volatility index and I suddenly see this massive spike going up on the volatility and the market seems to be doing this, I can tell you now it's going to drop. And I'd rather wait for it to drop because the volatility is already spiked. Now, how can you tell if volatility is going to spike? It's not a hard and fast rule, but what I look for is 2 closes above a 2 standard deviation Bollinger Band, right? So if the volatility is coasting along the bottom band, and all of a sudden I have 2 closes on a 5-minute chart below that band, I can tell you now it will revert to the mean. So it's going to move and it's going to jump back to the middle. So we're going to see a price decline in the index. We're going to see some stocks taking some heat, and it might push through to the top end of the band. When it gets to the top end of the band, 2 closes above on the 5-minute, it will come back down. So all of these things become relevant when you start looking at your trading plan or timing an entry into the market. You don't just enter because the market was up. And that's crazy speak. So I look at those. I look at the put-call ratio. So when the put-call ratio starts to increase, and now this to me is a contra-indicator, because when every single person and their mother is buying puts, it means that the market can only go up because everyone has now gone to say that, look, the market's going to decline. So when everyone is saying the market's going to decline, it opens up the space for people to go, no, the market's going to go up now. People start buying calls. So when people have bought put calls, or if the put call ratio is at 1, I end up buying call options because I know that things are going to be coming back. And similarly, when people are buying too many calls, I go to the put side and I'll start buying puts, because you always have to look at the contra to the market. Everyone wants to be part of the market moving the same direction. The smart money, all right, you do know that in finance, they have smart money and dumb money, right? The dumb money is the people like us, right? And what we've got to try and do is move slowly out of our little Venn diagram. If you think of a Venn diagram, I'm trying to move this way towards the smart, and the smart guys are trying to move further away from me, right? It's like catch up. But 99% of the retail investor sits in the dumb money circle over here. And the smart money sits over here. And you have a group of people that are, I would call them slightly more educated, but not necessarily smart, people like us, sitting in the middle. And we oscillate between these two groups because what we try and do is build consistency of our result. So we're not as stupid as the dumb money, but we're not as smart as the smart money because we don't have the capital, we don't have the information, all of that. But we try not to get caught in the same traps. This is the thing, the market sets traps for us, right? So as retail investors, you know, people will go in and go, stocks rising. Oh, let me see if I can pull up some graphs and I'll give you some examples because this is really important. Let's have a look at, I'm just going to pull up this was a fairly interesting one. So I'm going to share the screen and you can see this one. So let's take a look at Baidu, for example. All right. So here's Baidu traveling along, doing really nothing, and it goes up. All right. 90% of the time, retail investors are going to be buying in somewhere around here in this period. They go, you know what? You got to buy Baidu. It's never going to come down, right? So they buy in here on this big green candle over here. And then all of a sudden, because they're buying in, it pulls back. This is when those same people who bought in here thinking it's never going to go down, panic. And they go, uh-oh, I'm out. I'm going to close off. Bang, they sell. Now they're out. They've just created some liquidity for the smart people who bought over here, and now they get that rise. Now the people who sold over here can't get back in. They've lost this money over here. And the people who bought over here are winning. That's the psychology of what goes on. Most retail people buy on rises like this. Okay, let's look at another one. Okay, take this one, for example, SNDL. So this one is one of the Reddit stocks being punted at the moment. So I've bought a couple of these shares, okay, and I look at it and I go, well, most retail guys will buy here on this green can. Lots of buying, right? Stock falls down. Oh, let's get out. Boom, and they sell. They had no plan or no reason why they went in the first place. What they were looking for is to buy it here and sell it there. So that was what they were hoping for. Didn't happen. They exit the position because now they've lost. In fact, over here, they would have been negative quite badly, right? The guys that go in with a plan, I'm looking at this and I'm going, you know what? Since November, it's been, look at the symmetry that happens here. Up, down, up, down, up. You can imagine that this is going to go up, down, up, down. It's just going to keep repeating the same process, right? So what do? Yesterday, we bought some shares. We got some shares at around 90 cents, somewhere around here. Now, the price went up big yesterday. We have this doji candle over here. Now we'll see where it lands up today. And I bought a call option because if this pattern continues, all right, and there were also other signals that came out in terms of the squeeze and all of these other things that came that are positive towards the stock, we start building a position, all right? So what we look at is we go, let's go in small. I can never be right all the time. I don't dump all my money in at the first trade. I put a small bit in. I let the trade work for me. Trade sends me signals. Every day, the trade will tell you, am I right? Am I wrong? If it's right and it gets to a certain checkpoint, 10% up, 20% up, 15, whatever it is, in your plan, you would have written it. You'll go, oh, it's up 15%. Let me go back and look at it. You check the signals. You check the reasons why you went into the trade in the first place. And if it says yes, it's still a trade, you take the next piece of money that you were going to allocate to the trade and you put it in. Because now you've got double confirmations. You've checked it twice. It's moving. You're profitable, perhaps. Now you add your next piece. Now you wait. You've got another checkpoint coming up. And with my guys, we use Fibonacci levels. We use all sorts of checkpoints at certain price points. We'll be checking in on those positions over the life of the position to decide whether we take profits, whether we add more, whether we stay flat, whatever it is. So you keep adding. And now think about this. If I put in 1/3 and then I put in a second third and then a final third, by the final third, my first piece that I've put in should be highly profitable, particularly if I'm using options. What I do then, when I'm putting in my final third, is I sell my first position. I close it off. I take my capital off the table and I use the profit from that first position to buy my next position. So all of a sudden, I'm now risking even less money and I'm still in the trend. And then when the second position comes out, I take the capital off and I use the profit to buy my next position. So within 3 of these transactions, I've actually risked nothing. I'm now zero risk and I have this position that's been watched for some time that I'm now capturing that trend. And that's how you get to have low risk, very low risk trading, right? That's the way I do it, is I try and look for opportunities to take my money off the table. First rule of trading is don't lose. So if I'm not using my own money and I'm using the market's money to do this, I can't lose my capital. My capital sits in cash. And most people, what they do is they look at their cash balance. They go, oh, I'm not making anything. What you've got to do is have the mindset of I'm not losing anything, because the system is designed to take that money from your account and put it into the other guy's account. So as long as you set up your process to not lose, you'll be successful, because the winning will take care of itself. You know, if you think about what these broker platforms were doing when GME was going skyrocketing.
Yeah, I was going to ask you about that. I know that at least Robinhood, I'm not sure what other platforms, they were limiting the person's ability to buy. And I watched an interview or listened to a podcast, I can't remember where, about how those platforms, they make money by taking the opposing trade side because they know most people that come onto the platforms lose.
Yeah.
Their idea was that they didn't want to lose any more money, so they limited the.
Man, you know what? I watched the CEO have an interview on CNN, and I find it it's the optics, the technicalities aside, whether they had a liquidity issue, whatever it is, it's the optics of the whole thing. What are you doing? If you're a broker platform designed for the masses to give them access to trading, and when this is the irony of it, Steve Cohen, okay, I think is he S3? I think he's S3 Capital. He used to be the manager and mentor of Plotkin. S3, I think, I stand corrected, but I think they own shares in Robinhood. So you've got this guy at the top whose protege is losing billions, and he happens to own a portion of the platform that's causing all these losses. What are you going to do?
I think there's a little bit of collusion there to shut that down.
You know what? They'll deny it, but at the end of the day, it's the optics. Whether they deny it or not, what does it look like, right?
Yeah.
So, they can prove whatever they want. I look at it as a potential customer, and I go, I wouldn't trade with them. I don't trust the ethics of free trading, because you have to make your money some way, right? Where are you making your money? If you're not charging me a fee, tell me how you make your money. Maybe they front run the trades. I don't know. Maybe they take spread differentials. I have no clue.
I've heard a couple of things where they shave a couple of cents off.
Yeah. I mean, to me, how ethical is that really?
Or if you think about the number of retail traders who lose money, if they just, with probabilities, if they just took the opposite side of every trade that's placed, they would probably come out okay.
Probably. Yeah, absolutely. So I don't know, man. It's looking at it, I got screwed by my broker. He reversed a whole lot of transactions on me after the market closed. Basically they went and did the hunting of trailing stops, and I had some volatility trades in play. And, I had a trailing stop, and at 5 minutes after the market closed, they just pushed the price down on these index options and took me out. And the next morning it opened up and I would have made a bit of money, and they basically closed me. So it happens all the time. I don't lament about it. I just go, okay, well, in future, what I'll do is I'll take my trailing stops off at 3:45, and they can't do that to me then, because they've got no instruction to work on. This is the problem with trading as a hobby versus trading as a living, right? If you trade it like a hobby, you're going to get hobby results. You never ever see hobbyists become world champions. If you want to be a world champion at anything, you've got to put in the time, the effort, the training, the practice, the mindset, everything. I don't know anyone of the professional traders that I trade with, that I'm in a community of, that were in on GME. Not one. So I look at it and I go, if the professionals aren't playing in that game, why are the hobbyists? And what makes the hobbyists think that they're going to win? And this is the thing about trading, is that at some point, these guys will all level off. That profit that they make will be given back in some other trade, some other way, because they didn't have a plan. They weren't trading to any form of process. So, I applaud them for winning, but I hope that it doesn't embolden them to think that they're going to be able to repeat it, because they will change the rules. A couple of years ago, I think it was 2009, the day trading rule came in. There was also the rule about the $25,000 liquidity that came in. All the brokers are going to do is they're going to go, well, because of all of this AMC and GME nonsense, we're going to increase the capital requirement on option trading accounts. So now they've just shot themselves in the foot. How good is it going to be if the brokers say, well, you need $100,000 now to trade options, because we want to avoid any form of volatility like this.
Do you see that happening, new regulations?
Anything will happen. But, I don't know. Politicians are all jumping on the bandwagon now, and everyone wants to wag their tongues and say whatever they want. I mean, they're just toothless animals, really. But they land up doing stupid things. Never ever underestimate the collective stupidity of a group of people. Like, take a group of people, give them a title and tell them to fight for a cause. You can get whatever you want done, right? So all of a sudden, you've got these politicians jumping on, how the Wall Street guys screwed the traders. You know what? Wall Street's been screwing us for centuries now, or hundreds of years. Why all of a sudden are these guys getting on the bandwagon? And you know what the funny thing is? Most of the people that are saying, oh, screw Wall Street, they are funded in their campaigns by the same people they're criticizing. So, you can't trust a word that comes out of their mouths.
I don't.
Could they change the rules? The brokers will probably change the rules. I wouldn't be surprised. Yesterday I tried to do a trade on NVAX. We did that trade last week on NVAX. We got the big move on Friday. When you look at that, we traded it on Friday. We bought in. No, it wasn't on Friday. We did it. Friday got the move. We did this on Monday of last week. We got the move on Friday. We had the move yesterday. I wanted to reset this trade, take my profits off. I had another 70% gain on that trade since Friday. Nope, couldn't do it. They blocked off. You weren't allowed to do any trades on, or any spread trades on NVAX. They didn't announce it. They didn't send me a note. They just, nope, rejected, not allowed to do the trade. These guys will change the rules. And if they do change the rules, I think it's going to be more damaging to the retail guy than it is going to be to the institutions. So I think things are fizzing out a little bit when you look at GME and all of that. I think, look at that. Pity the guy who bought up at 478. Like, here it is at 127. So there were stories on the weekend of these kids going and mortgaging their parents' houses and buying this stuff. And I look at that and I go, do I feel sorry for them? You kind of do in a way, because there's the stupidity that you just wish you could have told these guys not to play in that pool, but now they go and play in the pool. How is the guy who mortgaged his parents' house for $30,000, who bought 100 shares up here, going to survive the 43.48% decline that's going to happen today? I just don't get it.
People are going to be, if you give someone a powerful tool, some people are going to get destroyed. People eat Tide Pods. That was a story for a while.
So, man. This is the thing about the collective stupidity of groups, right? Like, this is why I stay off chat groups and I stay off WhatsApp, and I try not to talk to people who know less about trading, because the thing is, you surround yourself with 5 really smart people in trading, you'll become a better trader. If you surround yourself with 5 idiots that all lose and all play these games, you're not going to get better. So, this, I don't encourage people to join chat groups about stocks, because you never know who the person is on the other side. Like, what if it's this guy who's just trying to front run a position that he's got, and he transfers his bad process to you? Hey, look at this stock. It looks great. Yeah, I trust this guy, Frankie 08957 Samusa or whatever. I don't know. And I trust the guy. Why do you trust him? Oh, because he had a winner last week. Yeah, but he had 27 losers he didn't tell you about.
He's got a really nice car in his avatar pic.
Yeah, he's got a cool avatar with diamonds. I think that this is where a lot of guys will get into trouble with trading. This is not a game. When you start playing with people's money or with your own money, you've got to take it seriously. And you don't walk into a casino with $1 million and go, I'm just going to put it on red and see what happens. You don't do that. The odds are so stacked against you. Why would you do that? And if you do win, you've got to respect the win and walk away.
It's like playing the lottery. Do you ever play the lottery?
I already pay too much in taxes.
Yeah, it seems like it's like $1 or $5 or whatever, but your chances of winning, or you do the butterfly, which that's your lottery trade, right?
I use butterflies as a lottery. I find butterflies for me because there's a principle of math behind it. I'm using math. I'm not using any form of superior crystal ball skills. The market tells you what's going to happen. And if you can just find these little nuggets and then piece them together, you can build these trades. I don't win every time. Man, my win rate on butterflies is probably one out of 10. But the thing is, I'm not putting down a lot of money, number one. But my gains when I win are big enough to compensate me for the losses I take and make a profit. So I budget in my plan to have a win rate of between 15, 20%. That's usually what I look for. If I get a better than that return or better than that win rate, I'm doing really well on butterflies, on that strategy. And it's a strategy that most people stay away from, to be honest, because of the complexity of calculation. But actually, it's not that hard, because and I'll talk you through one. So if you're in a broker platform like Thinkorswim, let's pull up a trade. Let's look at Microsoft. All right. So Microsoft, I have a reset trade at the bottom here. Let me just close that off. Okay. So if I'm looking at a Microsoft trade for this week and I'm going to use a call butterfly, all right, the idea of the butterfly is a net. All right. The smaller the net, the harder it is to catch that damn thing. Right. So the further out I go in time, the wider my net needs to be. The closer in I go, the smaller my net needs to be, because I don't want to overpay for this. Right. Remember, if I pay too much for my butterfly, my risk reward is not going to be where I want it to be. I want these to be 5 or 6 times my money. Right. I don't want them to be 1 or 2. Right. Especially if it's close and small, because the chances of that stock shooting past my net is still pretty real. So let me show you how you would do it. So let's say I'm going to do a butterfly for Microsoft on the 12th of February. I'm looking at this number here. You see this 1105 rounded up. That is what the market is telling me Microsoft will do between now and the 12th of February. All right. So between now and the 12th of February, the market is saying Microsoft is either going to be 250, nice big round number, or it's going to be 228, somewhere around there. I'm probably going to say with Microsoft, let me open up a graph. If I look at Microsoft, so you got all my old charts here. If I look at Microsoft and I look at its TTM and I look at its graphs, I would probably say with this TTM rising, Microsoft's probably going to be rising in price. All right, so 250 would probably be where I think Microsoft is going to land. So 11 plus 239, 250. The market loves big round numbers, right? They're psychological. 250. It's much better than 249.96. It's like buying something. We'd rather just get that big number. Okay.
You always try to round to the bigger number.
I try. Yeah, I try. So because I'm going out 10 days, I want my net to start off quite wide. All right. Because I'm looking out 10 days. A lot can happen in 10 days. So what I would do is I go in, I'm on the 250. I'm going to be buying a butterfly, but I'm going to change my downsides, right? I'm going to start my net at around 240. So I'm just going to drop that to 240. And I'm going to increase this to 260. So now my net is 10 wide on each side, and Microsoft is just about to fall into the net. And if it can stay inside the net, I make money. If on the 12th of February, Microsoft lands at 250, so on Friday the 12th at 345, Microsoft is at 249.95 or 250.05. I'm going to max out on this trade. Max out.
So what's the return on that?
So this is going to cost me $230 to put this trade together, and the maximum I can make is 770. So this is telling me 770 divided by 230. This is giving me a 3 times return. So 3 times return. I could literally go in here, buy this now, set an order to close this at 2 times my return, right? So I would sell this for 460. I'd put a closing order in for 460 and walk away. And when this hits 460, it closes off. I've just made 100%. Done. All right. I don't really have to hold it till Friday next week. Okay. Now, as this Microsoft trade, as the stock starts to move up closer and closer to that middle strike, my profitability starts to challenge, right? So it starts to get affected. Because as it's moving up, remember this number, this 11 number over here, also will increase. So now the market is saying, oh, it's moved up, so now it's going to land there, it's going to land there, it's going to land there. It's going to keep moving the target as we get closer and closer to the end of the expiry, right? That target can be adjusted down or up, depending on what happens to the stock. So what I'm looking for is I start my first one wide. And as Microsoft's moving closer and closer to the expiry, I'll add another one. Maybe I'll add another one at slightly different things. We were doing this on Tesla a couple of months ago, where what we'd do is we'd start off pretty wide. So if we look at Tesla, we would go out maybe 17 days, 3 weeks, right? Look at the price change that it's expecting here. They're expecting a move of $100, right? So we would go to 950. Let's just round it up. 950. We'd buy one butterfly here, make it a 10 wide. So or make it 20 wide. So 930, 950, 970. It's going to cost me 78 cents, right? So we've got one. That's going to give me $2,000 back for $78 down. So you can see what's happening now, right? I've got this wide net that's costing me a little bit of money. If Tesla does just what the market says it should do, $100, right? It's going to move $100. So we can make this even wider to start. So we go down 50. Let's go to 900. See what that's going to cost us. 900. See the price changing already? Mm-hmm. So now if I do a 100 wide, it's going to cost me $400. But look how much it's going to give me. 4,000. That's a 10 times return on one trade for 400.
Wider than that, the higher your probabilities are going to be for this.
Yeah, the wider the net, the more probability I've got that it will fall into the net, right? But don't forget, Tesla's still trading $70 below my starting point, right? So if Tesla drops for 2 or 3 days and doesn't come back up, I lose that 485. It's gone. So these are what I call no regrets type trades. You put it in, you've got to be prepared to lose it because 90% of the time you will. But imagine this. If I did the Tesla one and I nail this Tesla one and the cost of my other butterflies that I'd put in play was 78 cents, 90 cents. I've spent $100 on maybe 10 other trades. And I land up winning on this and I make $5,000. I would have probably spent maybe $1,000 in total across all of the flies to make that. So when you do it, I have a rule. I cannot do a butterfly trade unless I've made my income goal for the week from my other trades, the higher win rate trades, right? So long call debit spreads, my bull put credit spreads. If my other trading strategies have delivered the results for the year, for the week, I have permission to start adding these in. All right. So once I start adding these in, and let's say I do this one on Tesla and Tesla starts to run up. So let's imagine Tesla lands up going from it gets to 900 next week. All right. All of a sudden it's at 900. What do? I don't want to lose this $500. That would be crazy. The immediate action that we take is we call them defending the position. So if I've taken a bet on one side, I have to find a credit-based transaction where I'm getting paid the equal amount that I've spent. So even if I lost on Tesla and I didn't win on the call, I could win on something else, making my loss zero. I would sell a bull put spread. So as soon as it hits that middle strike, if Tesla got to 950 and it was surging through 950 and all the indicators were positive, everything is saying this price is rising, this price is rising, you sell a bull put spread for the same value of credit that you've paid on the debit side. You're now risk-free. Well, not risk-free. You're not going to lose anything. You might have lost on the first trade, but you won on the second. The net result is
yeah. They sort of cancel each other out.
That's it. So even though you lose, you win because you land up not losing anything, right? And that's the second thing about trading is the first rule is don't lose. First rule, don't lose. Second rule, make money. Third rule, if I am going to lose, try and lose as little as possible. Don't just capitulate. It's like tapping. When those guys tap to really bad technique, it's like, when the guy does a rear naked choke on the guy's chin and he's like grinding the guy's jaw and he's cracking the teeth and everything, and you go, why did you tap?
Or like you just put your arm around their neck and they're like tap. I'm like,
yeah, tap.
Come on.
You don't capitulate in trading for the simple trades, right? So the process I have is win on the ones that are easy to win. Bull call spreads in an up market, pretty easy to do, particularly if you've got the right stock, the right indicator, and you buy the right delta. All right? Don't be a Robin Hood nonsense trader that goes and buys out of the money call options and loses 99% of the time. That's crazy stuff. That's why the Robin Hood guys make money, is because they're the ones selling these guys these option trades. So it's nuts, man. I don't understand why they would do it. So you buy the right deltas, you sell the right deltas. You make your profits based on expected moves of stock, right? Once you've made your goal for the week, do these lottery trades and you add some of them in. You throw a couple of butterflies on. I try and have around 7 to 8 a week that I've got in. And I add in things like iron condors as well. All right. So particularly around earning season, I will do iron condors.
And there are some stocks, I think we'd actually discussed this before, some stocks that follow the predicted move a lot better than others.
The thing that I try and look at is the indicators, right? So if I've got a stock that's got, a rising RSI, positive MACDs, TTM squeezes indicating, a blow to the long side, and I've got compression on the squeeze. So the stock is trading. The Bollinger Bands have compressed into the Keltners. So there's compression on the price. Then you can expect a greater than expected move. All right. You also have to look at that, where that move sits in relative to the Fibonacci levels. Because if the Fibonacci level is above the expected move, you might have the stock move towards the Fibonacci level rather than the expected move. So everything, a lot of traders make the fundamental mistake of looking at one indicator. I bought this because the RSI was high. Okay. Did you win? No. Okay. So that indicator might not have worked by itself. The thing is, all indicators work as a collective. It's like a football team. You can't win a football team with 15 quarterbacks. You're going to have some guys in the front. I don't even know American football, so I don't know why that thing even came out where I said quarterbacks. I don't even know what they do. I know that they're the smallest guy on the field. And you see some of those guys are built like houses.
Right.
You can't win.
They pass the ball. They hand the ball off. They can run the ball. They're sort of like the
guy who gets the goal.
I always think of it as sort of this version of a battlefield, right? You've got your cannon fodder, and then you've got your general in the back kind of calling the plays and all that sort of thing. So they're like two clashing lines. It's kind of interesting.
The thing that you've got to have is you've got to have a strategy that's based on having a number of players in your team. So you can't just have 15 quarterbacks, right? So you need to have, some of the trades are going to be like long call positions. Those are going to be like your wing players or whatever it is, the guy that sprints down the side. He's the guy who's going to catch the ball and he's going to score. Sometimes he misses the ball completely and falls into the ice bucket on the side, right? That happens. So, but you want to give him a chance, right? So those are your long calls, right? Your bull call spreads are like that guy, but it's the guy running next to him that pushes the other guy out of the way, right? They're the defense. They're going to get you to the winning line, but you need those in play. The bull put spreads are like the guy in the defensive position. They're going to be defending your portfolio. So if you set them up right, you're going to be winning, consistently with these guys, right? And then you need your quarterback. Your quarterback are your butterflies. Because if you can land it, you will win a lot. But you've got to have chances to win, right? You've got to set them up ahead of time. You can't just set them the day before. I've hardly ever won when I've set it up a day before. Where I've won the most is when I set them up maybe 7 to 14 days before expiry. I start off wide, And as the stock starts to develop and I've paid a little for that one, I'll add another one. Then I'll add another one. Eventually, I'll have 5 or 6 nets on one expiry day. And I'm going to win on maybe 4 of them.
I've done a couple where I actually got paid to buy them.
Oh, on the unbalanced side, right? So if you're doing an unbalanced put butterfly, you get a credit. Yeah. Those are slightly more complicated because you need to have a stock that's going to go up, and it does sometimes retrace. Remember, if I'm using an unbalanced put butterfly, I receive a credit coming in. I'm going to sell it for a credit going out. So it's the same principle as a bull put spread. But what I want on the unbalanced butterfly is I don't want the stock to drop down too far below my lowest strike, right? Otherwise, I lose the whole lot, right? So there is some downside, upside, if you understand. But, if the stock does fall, I can make a bit more money. But ultimately, what I'd want is for that whole position just to expire worthless, and I keep the full credit. So unbalanced butterflies I sometimes use as a defensive position against a call butterfly that's not working, depending on the stock. There's always this little asterisk, depending on the stock and depending on the signals. You don't just do it as a random trade.
Quick question about a lot of there was a big run on silver, a big spike in silver. Is that do you think that's one of the, because I saw some screenshot of the Wall Street bets guys talking about SLV. Do you think that's another GameStop, or is this something that's
the thing that I looked at yesterday was the pre-market moves in silver obviously exclude all the retail guys, right?
Mm-hmm.
So they couldn't have participated in it before 9:30. And the real major move yesterday happened before the market opened. So I don't believe that it was entirely them. I think they may have a role to play, might have a role. I think what's happening is all these institutions that have got manipulative short positions in play, right? So I remember trading silver 10 years ago, and you had JP Morgan was quite involved in the shorting of silver and suppressing the price, and all of these guys, and they've got a huge short book on that, which I think they inherited from Bear Stearns back in the day. Anyway, that's going back decades. When you do this stuff and when you see these things happening, you've got to look at the time of the day that this happens, because retail cannot participate before 9:30, all right, or in the pre-market. So maybe before 9 o'clock. The big move in silver happened way before then. Silver is the most manipulated metal, right? It's not a safe haven at all. It's a manipulated commodity. So what we do is we look at it how I trade with my guys is we've got 5 or 6 really, really good silver production mines in our book, and we will trade SLV on the side. If this is going to be another one of these GME scenarios, I would be personally getting really nervous if I was the institution behind the shorting. And it's like the world's worst kept secret about who the guys are that are shorting silver. So, if I was one of these institutions, I would be worried.
But you think that this could be a continued uptrend in silver, maybe?
I would hope so, because I've got a lot of exposure to silver mines. So maybe that will get me to my favorite beach house at some point. I don't know. I try not to predict things. I think what you've got to do is participate in stuff and not predict stuff. If you participate in stuff, it's a little easier to deal with loss and being wrong. I think if you try and predict things, I'm an economist by profession. We are famous for being able to say 2 things and be right in both of them, right? So economists never take a stance one way or the other. I just don't think it's worth trying to predict. Silver a couple of years ago went from like $19 to $49 in 5 days, and then it came crashing back down in one. So I personally experienced the crashing down part pretty badly. So I'm well aware on how manipulated it is. If you want to play the silver game, you need to probably buy some really good mining stocks. One of the best is PAAS. In my day traders group, we had a double yesterday on that. We've got stock in AG, which is up about 100% since we bought it in December. That's the way I play it. I just wouldn't want to get into, I don't want to be sitting in front of a freight train, when it hits you to the wrong side, right? So rather trade the charts, don't trade your Reddit boards or whatever it is. You know, they might be useful in some context in terms of where sentiment might be moving. It's going to ring in a second. You know, what you've got to do, sorry, there's going to be a whole lot of bells going, you know, going off, but what you've really got to do is look at just trading a plan. You know, build a plan and stick with it. Don't try and you know, don't try and you know, predict anything. You know, it will keep you safe. Best advice I ever got was never try and predict anything.
Sounds good. Well, Chris, we'll let you get to your day of trading, and I
Thanks, man.
as always, and we'll talk again next week.
We'll see you soon. Take it easy, man.
Take care.
Have a good one.
You too.